Today is June 4, 2026. And if you are looking at the global economy right now, you are basically looking at a powder keg.
Oh, absolutely. It is highly volatile right now.
Yeah, we are sitting on this incredibly volatile convergence of geopolitical rupture, energy insecurity, and just acute structural uncertainty regarding monetary policy.
It is a profound shift. I mean, from the stability we all kind of grew accustomed to in previous decades, the fundamental architecture of the global economy is, it's being rewritten in real time.
Totally. And to help you navigate this, we are diving into an urgently updated paper from the Global Review.
Right, the one by Dr. Novon and Associates.
Exactly. Dr. Novon and Associates Global Industry Management and Economics Consulting Group. And what they've put together is a Bayesian Game-Theoretic scenario analysis. They prepared this specifically ahead of the upcoming 52nd G7 summit in Evian-les-Bains,
Which is in France. And that makes it a fascinating piece of research because it was originally submitted in late May. But then two major global developments forced them to basically pull it back and radically revise it just yesterday on June 3rd.
Right. So our mission for this deep dive is to figure out how a massive global energy shock colliding with a radical changing of the guard of the Federal Reserve has permanently killed the era of the temporary economic shock.
Oh, okay, let's unpack this. Because for a decade, between 2010 and 2020, we had this era of secular stagnation.
Yeah, the low inflation era.
Right, which basically meant sluggish growth, low inflation, and central banks that felt entirely predictable.
So why has that old rule book completely fractured?
Well, to understand the fracture, you really have to look at the sheer sequencing of what the global economy has just lived through. I mean, the old rulebook relied on the idea that shocks were isolated events.
Like a one-off thing.
Exactly. A bad thing happens, it causes a spike in prices, the central bank steps in, and then you have years of normalization. But look at the architecture of the last 5 years. We have not had isolated events.
No, not at all.
We have had 5 massive systemic shocks stacked right on top of each other.
Which means the system never really had time to rebuild its shock absorbers, right?
Precisely. Think about the timeline here. First, we had the pandemic supply and demand imbalances spanning 2021 and 2022. The global supply chain essentially just seized up.
Right.
And then, just as that began to unkink, we saw the Russian invasion of Ukraine and the resulting energy embargo in 2022.
And instead of returning to normal after that, countries started pulling inward. I mean, the paper outlines the massive global supply chain reconstitution and deglobalization pressures across 2023 and 2024.
Yeah, and that deglobalization phase is crucial to understand. When nations prioritize bringing supply chains home or, friendshoring, they inherently strip away global redundancies.
You sacrifice efficiency for security.
Exactly. So when the massive U.S. tariff shock hit in 2025, the global trading system was already fragile. It lacked alternative suppliers. And that primed the pump for the fifth shock.
The U.S. Israel-Iran conflict.
Right, and the Strait of Hormuz disruption that began in February 2026.
So we have a system where every new punch lands on a bruise that hasn't healed. And this relentless stacking effect is actively changing human psychology. I mean, Federal Reserve Governor Christopher Waller recently gave a speech in Frankfurt on May 22nd, and he explicitly warned that inflation expectations for the next 1 to 5 years are moving upward.
People just don't believe the fires can be put out anymore.
No, they don't. And the data backs up their skepticism. The April 2026 Consumer Price Index data showed headline inflation hitting 3.8%. That is the highest it has been since May 2023.
And core CPI, which strips out volatile food and energy, is stubbornly sitting at 2.8%.
Right, but here is where this actually hits your wallet, because real average hourly wages actually fell 0.5% for the month. Yeah, and to translate that, it doesn't mean your boss cut your paycheck. It means the money in your bank account buys 0.5% less than it did just 30 days ago.
Yeah.
You are actively losing purchasing power.
It is a painful reality for consumers.
It really is.
Yeah.
It's like the boy who cried wolf, but with economics. If the central bank steps up to the microphone and says, don't worry, this shock is temporary, 5 times in a row, people just stop believing them.
So how does this connect to what the paper calls Bayesian updating?
What's fascinating here is that Bayesian updating is exactly the mathematical formalization of your boy who cried wolf analogy.
No, really?
Yeah. In classical economics, if a central bank have a sterling reputation, a temporary shock shouldn't permanently change how people view long-term inflation. But Bayesian expectation drift means that economic actors, you, me, Giant corporations are constantly updating our probability models based on new evidence.
So when the disturbances just keep happening, we don't just think we have bad luck.
No.
We think the structural rules of the game have fundamentally changed. Exactly. The rational conclusion becomes that we have entered a higher inflation regime. And this changes behavior in very tangible, dangerous ways.
Like what?
Well, firms stop trying to absorb the rising costs of raw materials, and instead they immediately accelerate their price pass-throughs to consumers. They just hike prices.
Right, they pass the buck.
And workers look at their eroding purchasing power and start preemptively demanding higher wages just to stay afloat. All of this depletes the central bank's credibility.
And once that credibility is gone, controlling inflation becomes incredibly expensive in terms of job losses.
Very expensive.
So let's transition to the actual physical drivers of this latest inflation spike, the energy wildcard. The International Energy Agency called this disruption in the Strait of Hormuz the largest supply disruption in the history of the global oil market.
It's massive.
We saw Brent crude hit a high of over $114 a barrel in early May.
A staggering figure, really, and one that immediately began rippling through global supply chains. When diesel fuel spikes, the cost of moving absolutely every physical good goes up.
But wait, I want to push back on the panic here for a second. Because the paper notes that prices then fell 19% to around $92 by late May.
True.
And that was because of optimism over a 60-day U.S. and Iran ceasefire memorandum of understanding.
Yeah.
Shouldn't we be celebrating that? Doesn't a 19% drop mean the pressure is effectively off the economy?
Well, it provides a modicum of relief to traders, sure, but the physical pressure is definitely not off. First, that memorandum hasn't even received final presidential sign-off yet.
Oh, wow.
Yeah, it's essentially a draft. Maritime traffic through the strait remains completely crippled because insurance companies won't underwrite the risk. And just a couple of days ago, on June 2nd and 3rd, we saw renewed Iranian missile and drone attacks, along with U.S. responses.
So the ceasefire is basically on life support before it even starts.
Exactly. The conflict dynamics are entirely unresolved. But even if we assume oil stabilizes at $92, we have to look at the lag effect.
Right, the delay.
Because that price is still 20 to 25% above pre-conflict levels, those April energy costs, which jumped 17.9% year over year, they are already embedded in the system.
They are baked into the cost of fertilizer for this summer's crops. They're baked into the warehousing fees.
They are propagating through the pipeline right now that inflation will keep hitting consumers for quarters, regardless of what the spot price of oil does this afternoon.
Okay, so energy is acting as this massive inelastic pressure pushing supply costs up. But the paper also highlights another inelastic force pushing demand up.
The AI boom.
Yes, the AI paradox. Kansas City Fed President Schmid pointed this out. And it's wild. When we say something is inelastic to interest rates, we are basically saying the normal laws of gravity don't apply.
The AI boom is presenting a profound challenge to traditional monetary policy. Normally, when a central bank raises interest rates, it makes borrowing more expensive, right?
Yeah.
So a company looking to build a new factory sees the 8% loan rate and decides to pause the project. That cools down the economy.
It's like the Fed is trying to stop a speeding freight train by pulling the brake lever. But Schmidt is pointing out that the biggest engine in the economy right now isn't connected to the brakes.
That's a great way to put it. The tremendous surges in AI investment building gigawatt data centers, securing advanced semiconductors, laying new fiber networks. These are being treated as existential strategic imperatives by the major tech firms.
They don't care about the costs.
They genuinely believe that falling behind in the AI arms race means corporate irrelevance. So they have to build these data centers regardless of whether borrowing costs are at 2% or 10%.
Wow.
Hundreds of billions of dollars in capital expenditure are essentially just ignoring the interest rate environment.
Which means the Federal Reserve's primary tool for cooling down the economy is partially broken.
Exactly.
And that perfectly sets up the massive institutional earthquake happening right now. The economy is on fire, the hose is leaking, and we have a new fire chief coming in who wants to fundamentally change how the fire department operates.
Federal Reserve Chair Kevin Warsh. A profoundly controversial transition occurring at the worst possible time for market stability.
Warsh was just sworn in on May 22, 2026, after a highly divisive 54-45 Senate vote. When he was campaigning for the job, he openly promised regime change.
He talked about breaking some heads at the Fed.
Yeah, literally.
Yeah.
He softened his tone a bit lately, but then on June 2nd, he appointed Paul Winfree and Daniel Heil as temporary contractors for policy analysis. And neither of them has ever worked at a major central bank.
This represents a radical departure from institutional precedent. Federal Reserve chairs universally draw their senior advisors from within the central banking ecosystem, career economists who understand the internal machinery.
And their backgrounds are making massive waves. Winfree actually authored the Federal Reserve chapter in the Conservative Project 2025 mandate.
Yes, he did.
In that chapter, he advocated for eliminating the Fed's dual mandate. So instead of balancing employment and inflation, the Fed would focus solely on price stability. He also advocated for aggressively shrinking the balance sheet.
And originally, he even floated the concept of free banking.
Right. Which would drastically reduce the Fed's regulatory power over private banks. Now, to be fair, he has since backed away from the idea of nuking the Fed, but he's clearly very reform-oriented. And Heil is a Hoover Institution fellow who primarily focuses on federal health care and Social Security.
Now, before we analyze the market signal this sends, we need to be strictly objective about the politics here.
Yes, definitely.
We are not weighing in on the merits of Project 2025 or the Trump administration's broader goals or Winfree's specific policy blueprints. We are evaluating this purely through the lens of Dr. Novon's analysis.
Right, we are totally neutral on the politics. This is strictly about the mechanics of the global markets reacting to a sudden change in the rules of the game. So why is hiring two outside think tankers such a massive Bayesian signal that causes traders to panic?
It signals that Warsh intends to pursue a structural reform agenda that challenges the Fed's traditional operating framework, rather than maintaining the status quo.
Okay, that makes sense.
There is a deep tension between his signals and his actions. At his swearing-in, Warsh explicitly claimed he supports the dual mandate. Yet his first hire suggests a completely different institutional trajectory.
And markets hate uncertainty.
They despise it. They are now forced to ask, is Warsh merely drawing on Winfree for diverse analytical capacity, or is he quietly adopting these sweeping structural prescriptions?
Here's where it gets really interesting. Because he's dropping this bombshell into a room that is already deeply fractured.
The FOMC.
Yes, the April 29 Federal Open Market Committee vote, which was Jerome Powell's last meeting as chair, was an 8-4 split. That is the most divided Fed vote since 1992.
It illustrates the intense internal conflict over how to handle the sticky inflation. You had three hawks on the committee, Hammett, Kashkari, and Logan.
And hawks generally prioritize fighting inflation over protecting jobs, right?
Exactly. And they were entirely opposed to signaling any future rate cuts. And on the other side, you had one dove, Mirren, who wanted an immediate rate cut to protect the labor market.
And Warsh has to walk into that room and somehow build consensus. But wait, it gets even more dramatic. Former chair Jerome Powell is still sitting at that table as a rank-and-file governor.
Yes, he is.
Because of the ongoing Justice Department's renovation investigation proceedings, he was legally prevented from departing the board. So you have this unprecedented human drama. The politically appointed new chair, who wants to break heads, sitting right next to the former chair in a totally divided room.
If we connect this to the bigger picture, this domestic institutional chaos is spilling directly onto the international stage.
The G7 summit.
Yes. The 52nd G7 summit in Evian-le-Bain is facing a coordination problem that looks alarmingly like the stagflation crisis of the 1970s. France is desperately pushing for economic convergence among the allies, but Dr. Novon outlines 5 massive divergences splitting the G7.
Let's unpack those divergences. We have monetary divergence, where different central banks are moving at different speeds. Fiscal divergence, meaning governments are spending differently.
Energy security divergence, which we saw with the varying exposures to the Hormuz crisis.
Right. Political economy divergence. And now, this brand new 5th one, institutional uncertainty at the Federal Reserve.
That 5th divergence is an absolute nightmare for diplomatic coordination. The summit relies on months of preparatory work.
Like the Sherpas meetings.
Exactly. The 3rd Sherpas meeting in Toulouse, which finalizes the summit texts and agreements, happened on June 1st. They finalized their official positions before Warsh announced these highly controversial advisor appointments on June 2nd.
Oh man, so the delegations are scrambling.
Yes.
They are arriving in France, having to process a potential regime change at the absolute anchor of the global financial system in real time. and with draft texts that are already completely outdated.
Because of this chaotic environment, Dr. Novon's paper makes several urgent recommendations for the G7 leaders.
What are they?
First, they must issue a strong collective reaffirmation of central bank independence to calm the markets. Second, they need to establish medium-term fiscal consolidation framework.
Basically get their spending under control.
Right. You cannot have national governments spending heavily while their central banks are trying to tighten the money supply. They just cancel each other out. And third, they need to prep a coordinated strategic petroleum reserve release just in case the fragile Hormuz ceasefire collapses entirely.
Which brings us to the ultimate question. What actually happens next? The paper lays out 4 game-theoretic scenarios, updated as of June 3rd. Let's look at the probabilities.
Okay.
Scenario 1 is controlled disinflation. They give this a 20 to 25% probability. This is the happy path, right?
Yes. The ceasefire holds, Brent crude retreats to $80 or $85 a barrel, and inflation naturally cools down without a massive recession.
Got it.
A plausible outcome, but notably not the most likely one, due to the sheer structural damage to the energy transit routes we discussed earlier.
Right, which leads to scenario 2. The modal scenario, meaning the most likely outcome, sitting at a 40 to 45% probability. Persistent supply-driven inflation. In this world, the strait remains impaired, core inflation stays stubbornly high, and the Fed is forced to hold interest rates at 3.50 to 3.75% deep into 2027.
This is essentially a stagflationary environment. You have high prices, restricted economic growth because borrowing is expensive, and a central bank paralyzed by structural constraints. It's a grinding, painful environment for businesses and consumers alike.
Then we have scenario 3, expectations unanchored at a 20 to 25% probability. This is where the Bayesian drift takes over entirely. The June 2nd appointment spooked the markets into believing the Fed has fundamentally lost its commitment to fighting inflation.
Right. And finally, scenario 4, global growth shock at a 10 to 15% probability.
What does that look like?
This envisions a sudden 2019-style financial conditions tightening event. It would likely be triggered by developing economies, which are projected to grow only 3.6%, collapsing under the weight of expensive energy and a strong U.S. dollar, and ultimately dragging advanced economies down with them.
Looking at these odds, what stands out to you? Because to me, the fact that unanchored expectations is tying with a peaceful resolution is wild.
It is deeply concerning.
I mean, a 20 to 25% chance that the global public just completely loses faith in the central bank's ability to control money. What actually pushes us from a grinding scenario 2 into a catastrophic scenario 3.
The psychological tipping point is entirely institutional. Scenario 3 has moved from a theoretical edge case to a highly plausible near-term outcome because of the human elements we discussed.
The people running the Fed.
Yes. Full de-anchoring isn't triggered by a couple of bad inflation data points. It is triggered by perceived capitulation. Imagine Chair Warsh forcing through an interest rate cut while inflation is still running above 4%, simply to appease political pressures regarding economic growth. Oh, wow. The markets would instantly assume the inflation fight is over and start pricing in 5, 6, 7% annual inflation permanently.
Exactly. Or it could be triggered by sheer public institutional paralysis. If Warsh and the Powell-era committee members engage in a public civil war over the fundamental mandate of the Fed.
Like arguing in the press while voting 6-6 in the FOMC room.
Exactly. If that happens, the markets will realize no one is driving the ship.
Yep.
The credibility asset drops to 0.
So, to bring this all together, the temporary shock era is definitively over. We are dealing with a deeply fragile global energy market where supply chains have lost their redundancies.
Right.
We have a Federal Reserve that is visibly fractured, operating under controversial new leadership that wants to change the fundamental rules of the game. And we have a G7 summit trying to coordinate a global response using a diplomatic rulebook that essentially burned up 5 years ago.
It is a profound realignment of the macroeconomic environment. The old assumptions simply do not apply to these new variables. And this matters to you listening right now, because this isn't just academic game theory or high-level summit politics. The distributional consequences of this above-target inflation hit regular households the absolute hardest.
Absolutely.
When real wages decline, you are the one paying the geopolitical premium at the gas pump and the grocery store, while corporations use their pricing power to protect their margins.
And as we conclude, I want to leave you with this final thought to really mull over. If the Federal Reserve, which serves as the ultimate anchor of the global financial system, is fundamentally shifting its mandate, its internal structure, and its entire operating philosophy,
Yeah.
we have to ask ourselves, How much of our own personal financial planning is still relying on an economic reality that simply no longer exists?
A chilling question to end on, and a perfect reminder to audit our own assumptions. Thank you so much for joining us as we unpack this incredible analysis from the Global Review. We'll see you on the next deep dive.